Let's say you have some cash on hand and want to invest it to increase its value. How will you use it? Do you choose a variety of shares or stocks? Or do you make a quantum leap and invest in cryptocurrencies, secure digital money protected by cryptography like Bitcoin or Ethereum? Or is it advisable to take a mixed approach and invest in both equities and cryptocurrencies? Let's discuss the pros and cons of putting your money into crypto versus stocks and share some ways to figure out which approach might work best for you. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. What is cryptocurrency? Cryptocurrencies are digital currencies based on blockchain technology, to put it simply. The cryptographic methods used to validate transactions are where the word crypto originates. These methods eliminate the need for a single central middleman, like a bank, which advocates view as one of the main advantages of crypto. Additionally, the volatility of cryptocurrency pricing, which entails the possibility of substantial gains or losses, is well known. Learning the fundamentals can help you make the most of your investment if you decide to take the plunge. You should choose where to invest your money before you invest in cryptocurrencies. There are thousands of cryptocurrencies available, and the number keeps growing every day. However, some are more well-known than others. They consist of Dogecoin, Tether, Ether, and Bitcoin. What are stocks? A stock, usually referred to as a share, denotes ownership of a portion of a business. The holder of the stock frequently has a right to receive a dividend representing a commensurate share of the company's profits. Stock exchanges like the London Stock Exchange and the New York Stock Exchange are where stocks are typically purchased and sold, or traded. Stocks have long been a popular investment choice for many investors since, when a particular firm succeeds, so do the individuals who have money in it. They can choose to sell their investment for a profit if its value rises. Of course, businesses aren't always successful, so investors run the danger of seeing the value of their investment decline as well. Now, let's take a look at the 5 key differences between crypto and stocks. Number 1. History. The history of stocks and stock exchanges is illustrious and long. The first stock exchange, the Amsterdam Stock Exchange, was founded in 1611. Following in 1698 and 1792, respectively, came the titans of the London Stock Exchange and New York Stock Exchange, which helped to shape the modern financial landscape. Since that time, stock exchanges have solidified their position as a foundational element of our financial system. Nearly 1 million trades occur daily on the London Stock Exchange alone, while 2.4 billion shares trade hands every day on the New York Stock Exchange. Stocks have typically provided rather constant returns for investors, despite the fact that investments might vary up and down. For instance, the S&P 500 index's annual average return on the stock market from 2011 through 2020 was 13.9%. Unlike equities, cryptocurrency has only been around since 2009, making it the new kid on the block. Since the release of Satoshi Nakamoto's white paper on Bitcoin in 2008, public interest in and awareness of cryptocurrencies have exploded. Between 300,000 to 400,000 transactions per day were recorded for Bitcoin in 2020-2021, while over 1 million transactions per day were recorded for Ethereum in July 2021. Number 2. Price volatility. Volatility is a phrase used to describe how much an asset's price fluctuates over time. While less volatile assets are more likely to exhibit greater stability, highly volatile assets might undergo significant price movements, both upward and downward. What, then, are the volatility differences between cryptocurrencies and stocks? In general, cryptocurrencies are thought to be more volatile than stocks due to the uncertainty around their future value and the fact that they sometimes aren't backed by tangible assets. Additionally, because the cryptocurrency market has a big number of crypto whales, individuals or businesses who possess a sizable quantity of a specific coin, these entities are more susceptible to the actions of investors. But keep in mind that even investments that are regarded as being less volatile, like equities, can occasionally face unforeseen volatility. Number 3. Regulation. The majority of stock exchanges are regulated by governments. Administrative authorities have broad authority to look into and punish any wrongdoing, such as the Securities and Exchange Commission in the U.S. These ensure, in the words of the SEC, that those who seek your investment funds must tell you the truth about their businesses, and people who sell securities must treat you fairly and honestly, putting your interests first. These safeguard both investors and the market as a whole. As evidence, one of the SEC's largest fines to date was the $13 billion assessed against JP Morgan Chase for its role in the most recent financial crisis. They are also not afraid to take action against wrongdoers. Since it prides itself on being decentralized and uncontrolled, the cryptocurrency market can be somewhat wilder than the stock market because it isn't subject to the same kinds of regulatory monitoring. Currently, governments are struggling with how to integrate cryptocurrencies into their current financial infrastructures. For instance, the Chinese government just outlawed all cryptocurrency trading and speculation, and even the IMF is asking for strict, comprehensive regulation of cryptocurrencies to shield investors from the market's volatility. Number 4. Scams and security risks. The marketplaces for cryptocurrencies are developing and expanding quickly, and this, along with the fact that they are mostly unregulated, makes them a haven for scammers of all stripes. These scams frequently center on attempting to get personal information from victims, such as the codes needed to access a person's cryptocurrency holdings, or convincing investors to transfer cryptocurrency to con artists who might be posing as trustworthy organizations. In 2021, there were more than 80,000 reports of cryptocurrency-related crimes in the US alone. Scams and security issues can also affect stocks. The pump and dump plan is one of the most well-known stock scams. In this scheme, the price of a company is artificially raised by making extremely exaggerated claims to entice investors to buy, and then the scheme's organizers sell their holdings at a much higher price. There are other additional stock frauds. Do you recall Bernie Madoff? In the early 2000s, his Ponzi scheme defrauded investors of an estimated $50 billion. Number 5. Diversification. If you decide to invest in stocks rather than cryptocurrency, you can pick among businesses in almost every industry and nation. You can own stock in US-based technology companies, Japanese automakers, and everything in between. This makes it possible for you to assemble a portfolio that is quite diverse and not entirely reliant on any one industry or region. As a result, you may be less likely to lose everything. There are more opportunities to diversify with stocks than with cryptocurrencies, notwithstanding the wide variety of cryptocurrencies and crypto assets, such as NFTs. There isn't really an easy way to completely diversify your assets, but you can lower risk by making sure you don't buy just one kind of cryptocurrency coin. If you invest all of your money in one sort of currency or in a small number of them, you put yourself in a riskier situation. Should I invest in crypto or stocks? So, is cryptocurrency superior to stocks? No, not always. You might think about investing in both, depending on your level of risk tolerance. Without leaving yourself completely exposed to the hazards of each investment, adding cryptocurrency to your stock portfolio can be a terrific way to add some important diversification and open the door to potentially profitable profits. Before making any investments, think about the following. What is the maximum you can lose? Your money may occasionally be better off in a well-hedged stock portfolio rather than in a cryptocurrency. How much money do you hope to earn? Cryptocurrency has the potential to offer bigger gains while stocks may typically provide more consistent returns. What is your schedule? Compared to the stock market's longer time horizons, cryptocurrency's price volatility may enable you to gain money much more quickly, but they can also result in substantial short-term losses. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.